And this is ATICS broadcast number 4. And we are going to discuss about tax on long-term capital gain for the financial year 2024-25. We are going to discuss about section 112 and 112A. So first of all, we see section 112. It starts with where the total income of an assessee includes any income arising from the transfer of a long-term capital assets, which is chargeable under capital gain. The tax payable by an assessee of a total income shall be aggregate of. So it says you are having a total income which includes the long-term capital gain also. So in that case, your tax will be as follows. Subclass A says, case of an resident individual and resident HUF, the income tax payable and the total income as reduced by the long-term capital gain. So in the total income, you have to reduce the long-term capital gain, and the balance we should calculate as per the slab rate as applicable. For the long-term capital gain, we have to apply the following tax rate. So if the transfer takes place before 23rd July 2024, a 20% slab rate applicable, which is we are following till now, along with the benefit of indexation. So the Finance Act 2024 introduced a new rate for the long-term capital gain, which is a 12.5% without indexation if the transfer takes place after 23rd July 2024. Okay. So the old rate 20% applicable for the transfer takes place before 23rd July. If a transfer takes place after 12.5%, after 23rd July, the tax rate will be a 12.5%. For a resident individual and HUF, there are two other benefit is there. It is provided in the provisions of section 112, subsection 1, class A. Okay. So what the provision says, where the total income is reduced by long-term capital gain is below the maximum amount which is not chargeable to tax. So if your total income after reducing long-term capital gain, for example, your total income is 4.5 lakhs, your long-term capital gain is 2.5 lakhs, then your total income other than long-term capital gain is 2 lakhs only. In this case, the maximum amount which is not chargeable to income tax is, in case of a new regime, is 3 lakhs. So if you are after new regime, up to 3 lakhs basic exemption is there, and in your case, the income other than long-term capital gain is 2 lakh only. So the balance 1 lakh basic exemption limit can be reduced in the long-term capital gain, and in your case, the balance 1.5 lakhs, your total income is 4.5 lakhs, the basic exemption limit is 3 lakhs. This basic exemption limit is applicable to the all type of incomes. So the balance 1.5 lakhs only to be taxable under long-term capital gain. Okay. So this is the benefit given to the resident individual and HUF as per this provision. And the second provision says it is also a beneficial provision for the resident individual and HUF, and there should be a transfer of capital asset. That capital asset should be a land or building or both, and that capital asset should be acquired before 23rd July 2024. If these 4 conditions are satisfied, the assessee can pay tax whichever is lower as calculated with indexation at the old rate 20%, and without indexation 12.5% at new rate. So whichever is lower can be the tax payable by the assessee only in case of an individual or HUF. Okay. So we will discuss with an example in our Excel template. We have prepared an Excel template for the benefit of the members of the ATICS. We will share the Excel template along with the broadcast at the end. So then the second case is domestic company. In case of a domestic company, So the same rate, if a transfer takes place before 23rd July, 20%, after 23rd July, 12.5%. So the no such benefit like a individual and HUF, the domestic company can have. In case of a non-resident, other than a foreign company and a foreign company, the same slab rate except the transaction specified in subclass 3 in this class. So what is subclass 3? The subclass 3 is related to long-term capital gain arising of a transfer of unlisted securities or shares of a company. That company should not be a public or substantially interested company. So in that case, without any selling expenses added to the cost of acquisition, without any indexation, a slab rate 10% applicable if a transfer takes place before 23rd July. And if a transfer takes after 23rd July, 12.5% is applicable. So other than this category, the same rate is applicable. 20% and 12.5% for a non-resident and a foreign company. Okay. So the next one is other resident cases. So we have discussed about resident, individual HUF, domestic company, non-resident and foreign company. Firm, LLP and other constitution are there. For all these have the same slab rate. If a transfer takes 23rd July, 20% with indexation. If a transfer takes after 23rd July, without indexation, 12.5%. Okay. Then this provision applicable for all the cases of section 112. This provision says where the tax payable in respect of transfer of a long-term capital assets even before 23rd July 2024, if the capital asset was a listed securities other than a unit or a zero coupon bond, then if the capital gain calculated exceed 10% of the capital gain calculated as sales consideration minus purchase cost, then the excess of 10% shall be ignored, as we have seen in the individual case. Okay. In simple words, I have a sale of long-term listed securities on or before 23rd July, before 23rd July 2024 for the value of 10 lakhs. Okay. My sale value is 10 lakh, which I was purchased 2 years back around 8 lakh. So without indexation, I have to pay 10% of the 2 lakhs, which is 20,000. I also have an option to calculate 20% with indexation. So in this case, I am not required to pay more than 20,000 because the provision says the amount exceed 10% of the capital gain shall be ignored. This example is not added in the Excel. I will add and share it to you. So the next we are going to discuss about section 112A. So notwithstanding anything contained in section 112, tax payable by an assessee on his total income shall be determined in accordance with the provisions of subsection 2. So even section 112 says a 20%, 12.5% rate for the scenario, various scenario. But if the conditions mentioned in section 112A subsection 1 satisfied, then the tax rate will be as calculated as mentioned in subsection 2 of section 112A. So what are the three conditions? The total income includes capital gain, and the capital gain arising from a transfer of an equity share in a company or a unit of a equity oriented fund or unit of a business trust. And security transaction tax should be paid for that transfer. So if these three conditions are satisfied, then the tax rate will be as mentioned in subsection 2. What subsection 2 says? The amount of income tax calculated on such long-term capital gain exceeding 1.25 lakhs. So that means up to 1.25 lakhs, the tax exemption is there for the long-term capital gain covered under section 112A. So in case of a long-term capital gain, for the transfer takes place before 23rd July, 10% applicable. If the transfer takes place after 23rd July, 12.5% applicable. Next. So as we have seen in the section 112, the same provision is there for a resident individual and HUF. For the minimum amount not chargeable to tax can be reduced, okay, as we have discussed in section 112. So the basic exemption limit up to 3 lakhs, no tax is leviable, even if the income have a long-term capital gain, okay. Then another is for the long-term capital gain rebate under section 87A is not applicable. If you have a total income including long-term capital gain, we have to reduce the long-term capital gain in the total income, then calculate rebate under section 87A, then we have to add the long-term capital gain to know the tax payable. Okay. The query: is the same tax calculation applicable for the old tax regime and new tax regime under section 115 BAC? Yes. There is no difference tax slab for the capital gain. Under both tax regime, long-term capital gain taxed at the same rate. If the conditions are tax satisfied, it will be taxed at 20% or 12.5% or 10% in both old and new regime. The same rate only applicable. Okay. Now we will see with the examples in our Excel template. So this is our Excel template. It is a very simple one, not a complex one. So very easy to get the tax calculation for the long-term capital gain. Okay. So for example, we may enter the purchase cost here. I assuming that purchase cost was 7 lakh and purchase expenses is 50,000. So total cost of acquisition will be 7,50,000. The purchase happened in the 2019-20. So for the cost of indexation for the 2019-20 will be 289. The cost of indexation for the 2024-25. The sale happened in 2024-25. The cost of indexation is 363. Okay. And cost of improvement is 1.5 lakhs, which is happened in the financial year 2022-23. So in this case, cost of indexation for the financial year 2023-24 is, sorry, 22-23 is 331. So if we enter the financial year for the purchase and cost indexation rate, then the indexed cost of improvement and indexed cost of acquisition will be calculated automatically. So the indexation only applicable if the transfer takes before 23rd July 2024. In case of an individual and HUF, resident individual and HUF, who is transfer the land or land and building, also has to compute the indexed cost of acquisition or indexed cost of improvement, if any, to know the exact tax applicable to him. I assume that sale consideration will be 12 lakhs. So in this case, selling expenses may be 30,000. It may be a commission expenses or something. So net consideration will be 11,70,000. So the long-term capital gain, if the transfer takes before 23rd July 2024, will be 63,456, which is a net consideration reduced by the cost of indexed cost of improvement, reduced by the indexed cost of acquisition. So this is the long-term capital gain on old method, indexation method. So the tax payable will be 20% on the 63,000 is a 12,691. So if the transfer takes place after the 23rd July, that long-term capital gain will be the net consideration reduced by the cost of acquisition. Hence, if a transfer takes after 23rd July, the long-term capital gain will be 4,20,000. So in this case, the tax slab rate will be a 12.5% on 4,20,000 is 52,500. But resident individual and resident HUF have the benefit of the provisions which says if the tax payable exceeds the tax payable under old method, the excess shall be ignored. Hence, the tax payable in this case, if he is an individual resident or HUF and the transfer of property is land or building or land and building, then the total tax will be the 12,691 only. So the tax should be whichever is lower. This is what the provision says. Okay. Thank you all. And I want to personally thank Mr. CAL Venkatramanan sir, shortly LVR sir, who shared the provisions of section 112 and very kind of you, sir. Thank you so much. And thank you all the members of the ATIC. And I will share this Excel template along with the broadcast. Thank you all.